Hey everyone, and welcome back to The Explainer. Today, we're diving into something really special. We're going to unpack one of the most fascinating corporate evolutions to hit the entertainment space this entire year. We are digging into the Q4 and fiscal year 2026 earnings report from Cineverse. Now, if you follow the media landscape at all, you know that trying to pivot from an old-school content distributor into a highly scalable, modern tech platform is, well, it's notoriously difficult. But as we're about to see, the numbers tell a story of a massive, super fast transformation doing exactly that.
Let's kick things off with a number that is just staggering. 67%. That is their year-over-year jump in fourth quarter revenue. I mean, in the corporate world, you almost never see a single quarter jump that huge organically, not without some massive fundamental shift in the game plan. What we're witnessing here is the immediate, literally explosive financial impact of Cineverse's brand new strategy playing out right in front of us. So let's get into section 1. A transformative quarter moving beyond the box office. We are talking about transitioning from the old Cineverse, which relied on unpredictable hit films, to a highly scalable, tech-driven future.
The difference year over year is absolutely massive. Q4 of fiscal 2025 was sitting at $15.6 million, and then boom, Q4 of fiscal 2026 rockets all the way up to $26 million. That's a $10.4 million leap. But you know, the really interesting part of this story is where that cash actually came from. A very impressive $11.6 million of that new revenue was injected straight from their brand new acquisitions. And the crazy thing, that was just from a partial quarter of actually owning them.
Now, when a company transforms this quickly, the profitability metrics can look a bit, well, complicated. The crucial thing here is understanding what's happening under the hood. They made some very deliberate investments to integrate these new mergers, which temporarily pushed their adjusted EBITDA down to $0.1 million. However, because they bought these companies at such great values, they recorded a non-cash $4.3 million bargain purchase gain plus a $2.9 million tax benefit. So when you roll all that up, it actually boosted their overall net income to $1.1 million for the quarter, which is up 51% from the prior year. Moving right along to Section 2, Acquiring Growth in Tech, Building the AI Engine. Let's look at exactly what they bought to fuel this massive Q4 surge.
It really comes down to two strategic pillars, both executed in a single quarter. On one side, you have Giant Worldwide. They're a media services provider, and what they really bring to the table are these incredibly deep, long-standing relationships with major Hollywood studios. Then, on the other side, you have IndiQ. This is a connected TV monetization platform that already boasts over 40 live clients, with another 75 publishers onboarding. So you see what they did, right? One side secures the premium content relationships, and the other side provides the cutting-edge ad tech engine to actually make money off of it.
But here's the thing. Having two great new assets doesn't mean much if they aren't talking to each other. To tie the whole shebang together, Cineverse unveiled Matchpoint Hex. This is an AI-powered metadata layer that sits perfectly on top of their existing platform, fully integrating that new IndiQ technology. It analyzes a massive dataset of over 2 million titles. Basically, it's the brain connecting the newly acquired muscle, and it perfectly proves their shift toward becoming a fully AI-native company.
That brings us to Section 3, the new business flywheel, multiplying value through integration. Let's break down the mechanics of how this actually builds long-term value.
Think of this as a perfectly interlocked machine. Step 1, Matchpoint's automated supply chain prepares the media. Step 2, that prepared content feeds directly into IndiQ's monetization engine. And Step 3, the advertiser demand generated by IndiQ instantly increases the value of every single channel, film, and TV title it touches. Instead of disjointed, clunky pieces, you get this recurring, highly scalable infrastructure that completely frees them from relying on the whim of a weekend box office.
This entirely cements their new identity. They are emphatically saying that they are no longer just a traditional distributor crossing their fingers for a blockbuster. They are, without a doubt, a fully integrated, AI-driven entertainment tech platform.
All right, Section 4, Franchises Fueling the Platform, Low Risk, High Upside. Because look, even with this brilliant tech pivot, they still need the content pipeline that drives actual human eyeballs to their ecosystem in the first place.
You still need great movies to run through that AI engine, and their upcoming slate shows they are leaning heavily into established franchises. We're talking the 20th anniversary 4K and 3D theatrical re-release of Pan's Labyrinth. We've got a theatrical relaunch of Air Bud Returns, plus a new installment of the horror hit Wolf Creek and streaming rights to The Toxic Avenger. These properties have built-in, rabid fan bases. That strategy drives targeted viewers straight to their streaming channels, like Screambox, which, by the way, just posted an 18% jump in subscribers year over year.
Their CEO, Chris McGurk, really hit the nail on the head here. He called it high upside with minimal financial risk. That is the whole playbook. They aren't throwing hundreds of millions at unproven, highly risky blockbusters. It's all about acquiring known properties, capping the downside risk, and using that super reliable content to fuel the tech engine.
And that exact strategy has built up to an insane number, 66,000. That is the volume of premium films, series, and podcasts just sitting in their digital content library right now. But here is the wildest part. That huge library is on their balance sheet for a book value of just $5.1 million. But actually, an independent valuation priced it at around $45 million. That is a massive, hidden asset just waiting to be continually monetized by their new AI tools.
So, let's look ahead. Section 5, the 2027 Outlook, Scaling the New Cineverse. The flywheel is spinning, the AI is integrated, and the pipeline is loaded. Let's talk financial forecasts for fiscal 2027. The trajectory they're on is just incredible. They closed out fiscal 26 at $65.7 million in consolidated revenue. But for fiscal 27, they are reaffirming guidance of $115 to $120 million. That's a 75 to 83% growth target for next year. And the foundation for that explosive growth relies heavily on pulling in over $50 million strictly from those new acquisitions they just integrated.
And here is the ultimate proof that this pivot was real. For the first time in the entire history of the company, technology platforms are projected to make up the majority, more than 50% of their total revenue in fiscal 2027. They've officially crossed the line from a box office-led business to one led by scalable, recurring infrastructure.
But, they aren't just aggressively growing the top line, they are keeping a really tight grip on cost too. By leveraging AI efficiencies and using their Cineverse services base in India, they've identified about $10 million in annualized cost reductions and synergies. And get this, $2 million of that was already locked in by March. That extreme cost discipline is exactly what gives them the confidence to project their adjusted EBITDA jumping up to somewhere between $10 and $20 million next year.
So, as we wrap up this explainer, I want to leave you with a question to chew on. We've seen how Cineverse is using AI to totally rewire distribution, to turbocharge their ad tech, and to keep costs incredibly low. Management even says AI is going to play a big role in their actual production soon. So you have to wonder, as this massive new flywheel speeds up, is Cineverse writing the ultimate, highly profitable blueprint for the entire future of the entertainment industry? Thanks so much for joining me for this deep dive. Keep learning, and I'll catch you on the next one.